20%. It's a big number, right? Especially when you're talking about buying houses. And especially when you add the cost of stamp duty on top of that 20%. And especially when you feel like every time you save a couple more percent for that total, inflation kicks in to slow down your savings, or house prices jump, and now your 20% goal is so much bigger. But there is a whole realm of lending where all you need is as little as a 5% deposit in order to get into a house. It involves something called lender's mortgage insurance. Hello Mountaineers, I'm Jordan from Mountway, and in this episode I'll be taking you through the ins and outs of LMI and low deposit borrowing. Okay, so what is it? Lender's mortgage insurance, as the name suggests, it's an insurance policy and it's for the bank. The bank takes out an insurance policy on you to insure them for the higher risk that they are undertaking in lending to you above their standard 80% threshold. Normally you would bring a 20% deposit to the table and the bank would bring 80% of the funds needed to buy the house. And in instances where you go over that 80% borrowing, for example, when you have less than 20%, that's when lender's mortgage insurance kicks in. But banks see this as a higher risk lend. And they take out lender's mortgage insurance as a way to cover them for the risk that they might lose on your loan. So let's say for some reason you can't repay and for some reason the bank forecloses. That's very far down the track. You know, that's kind of quite serious and advanced in terms of loan hardship. But if that does happen and the bank sells your property, there's a higher chance that they will lose money on the sale of that property if you're borrowing above 80%. And the closer you get to 100%, the higher the risk, which is to say that, you know, for example, if you borrow at 95%, that property value only needs to drop by 5% before the bank doesn't recover any money or might actually lose money recovering from you. Lender's mortgage insurance is in play. What does it do? It insures the bank for your risk because you're bringing less deposit to the table. So let's get a bit more into lender's mortgage insurance. Lender's mortgage insurance is an insurance policy. Like any policy, it is priced based on risk. So all of the metrics that go into your loan proposal also influence the lender's mortgage insurance policy that you pay. So that includes the size of the loan, because that determines potentially the size of the exposure to the bank. Your percentage borrowing, as I mentioned, higher is even more risky, less buffer involved in that property price. Location. Now this matters because certain locations are more prone, unfortunately, to fluctuations in their price. They're not always expected to go up. Sometimes there might not be many buyers, in fact, to buy a house that's in distress. The loan type, investment or owner-occupied. First home buyer, for example, also considered slightly higher risk because, you know, being new to the loan game. And the assessment type, and this is mainly about low doc and full doc. Most people will be doing full doc loans, but low doc involves less information put forward to verify things like your living expenses and your income, and therefore it's a high risk loan. They all affect the size of the lender's mortgage insurance premium that you pay to secure your bank. There are two main insurers in Australia that do lender's mortgage insurance. They are QBE and Helia. And this is an interesting situation because for a little while there, Helia, which former name was Genworth, actually stepped away from the market. They stopped doing lender's mortgage insurance. And as a result, QBE was taking on all of the insurance policies in this sort of loan category around Australia, and very, very soon they would probably get filled up, if you like. You know, insurers only have so much risk tolerance they can take, but luckily Genworth renamed and joined the fray again, and we have them both in the market. In addition to those two lender's mortgage insurers, we have several of the big banks self-insure. And what this means is they literally take a fee from you, which is the policy that you pay, and they use that to insure themselves. So it works very much like an insurer. Insurers take the fee and they hold it in an account, and they kind of work out that of those policy fees that they collect, they will have to pay out from time to time a certain amount. But if they've done their maths correctly, they will end up holding more in policies than they pay out. And banks do the same thing, some of them, Westpac, ANZ and CBA to a degree. And so there are some other options outside of QBE and Helia, but it's limited. One question that comes up often is, can you choose? Obviously, with banks self-insuring, that is a no. However, the other banks out there potentially can choose, and there are some examples of banks that offer QBE or Helia, but that's really rare. Most of them are actually just, we have one insurer that we work with, and if you come and lend with us in this category, you will use that insurer. You have no choice. Therefore, in some instances, the choice of bank is actually more driven by the choice of insurer than by things like who the bank is and what kind of product they have and what kind of the interest rate they have. So keep that in mind. You have no choice when it comes to a particular bank. Generally, you have no choice which insurer they're going to use. So how much does LMI cost? Standard LMI costs about 1 to 3% of your loan amount. Now I say standard because there is no standard really. I mean, the largest category of lenders mortgage insurance loans is probably from 80% to 90%, and it's also where the costs of the policy are the lowest. So 80 to 90% is one category, 90 to 95% is one category, and 95 to 98% is another category. And in those situations, you will end up paying more than 3%. It's probably easier to do a scenario here to indicate how it works. So let's say you have a $700,000 house that you want to buy. And we're looking at Western Australia. I'm in Western Australia, so we're going to use Western Australian stamp duty. $27,000. So all up to buy that house, you need $727,000. You have $100,000 in savings, and after you pay the $27,000 in stamp duty, your deposit, what you actually contribute to the purchase of the property, is $73,000, which is just over 10%. So your loan ends up being $627,000, which is just about 90%. And in that case, your lender's mortgage insurance premium will be $17,500. That's about 2.7%. All right, so that's in that range that's been mentioned. Clearly, if you go up into the 90 to 95 and 95 to 98%, that number is going to go much higher. In fact, it can get up to as high as 5% of your total loan. Something that's also very interesting here is to run that exact same comparison with a New South Wales-based property. Your lender's mortgage insurance premium is going to be $16,000. In this example, this insurer, who was Helia, does, see a greater risk with a Western Australian property than a New South Wales property. It might be fair, it might not be fair, but that's how they do their maths. And it's not necessarily a small amount when you take $1,500 difference over $17,500. There is a significant difference around Australia, the way this LMI cost applies. So how does lender's mortgage insurance work? LMI is assessed and payable whenever you do something to your loan, such as take it out in the first place or refinance. And so going to the example of taking out the loan in the first place, we just run through that example. You've got $100,000 to put in. When you translate through stamp duty, that looks like a $627,000 loan. And the bank says that's over our 80% threshold. We need the insurance, and the insurance policy costs $17,500 in Western Australia. So your $627,000 goes to $644,500 because you're adding on the cost of that LMI, and it needs to be paid at the time that you do the loan. Now, let's say you take that out, you sit on that for a little while, and then you want to refinance. Even if your property is increased in value and you've paid down the debt somewhat, you might be at like a 85% loan to value ratio at that point in time, still above the 80% threshold. And what happens in that situation is you still need to pay LMI, unfortunately. There's an asterisk there though, because if you stay with the same bank, or if you go to a bank that also uses the same LMI provider, you can potentially reassess that same policy. In the case of your loan to value ratio going down, you actually wouldn't pay any more. But if you went to a brand new bank with a different LMI provider, even though your premium will have reduced, you still have to pay it to affect that refinance. And the problem with this is it can leave you stuck with certain banks because, obviously the costs of changeover, there's always a couple of fees and things, but to add in LMI after you've already paid it on the first round can be a lot to swallow. And in fact, in most cases, many people don't choose to do that. They just stick it out with their current bank until they find a good opportunity that they can move on. Now, there are some ways around this. I mentioned, moving to a lender that uses the same LMI provider. Now, this issue with refinancing and potentially having to pay LMI policy again is quite important. I mean, it applies not only to refinance, it could be for any purpose, such as you want to renovate the property that you're in and you need to increase your lending. There's a potential to reassess and repay LMI at that point in time. But even more practically, one of the reasons why people move loans all the time is because their interest rates aren't very good. And it's worth understanding, worth knowing that banks do tier their interest rates. When you take on an 80 to 90% loan, you step into a higher risk category, you pay the LMI as a result of doing that, but then you also pay a higher interest rate than what other people in the market are getting for less than 80%. And some banks go further, they provide discounts for less than 60%, less than 50%. But the point is, you will not be on the best rate possible when you step over the 80% threshold. And certainly when you step over the 90% or the 95% threshold, your rates will not be that competitive. They won't look that good. And it's very, very important to remember, because oftentimes you catch yourself 3 years down the track and you're looking at this rate and you're going, this is rubbish, why am I on this rate? My bank sucks. And then, because you forget all about the fact that this loan is still considered to be a high risk loan by the bank. There's still an LMI premium sitting behind it, insuring the bank for your potential, foreclosure. And the rate is there as an additional measure. Banks price for risk generally, and that higher cost reflects their ongoing view that you are a higher risk lender. So one of the issues of LMI is you can kind of get stuck in it for a while. You can't refinance because you might cop another lender's mortgage insurance premium, but then you're in this situation where the rates aren't the best either. And that's not a lot of fun for a lot of people. It could take quite a while to get to that position where your loan to value ratio is 80% and you kind of can get out there and freely take up the best in the market. But look, for many, getting into the market sooner is the overriding consideration. And the logic there is that the way prices are increasing will cost me more money. I'll have to lay out more money to get a house if I don't take up this situation right now. So let's go back to the $700,000 house and the $17,500 premium. That's 2.7% of the total property purchase price. And in a year, in a good market, you can expect the price to go up that much, maybe more. So you incur that cost now so that you don't incur it later, because later you might have to take up the LMI anyway. So house prices are going up, you've still got to borrow in a high risk category, you still incur the LMI, and you're paying more for the house. So for a lot of people, getting in now is the key consideration, and oftentimes I actually agree with that. I think the way some prices have risen, it makes sense to get in sooner. Not always though. There's also an attraction to LMI with investors because it is a tax deductible generally fee. And so, the $17,000 odd, for example, depending on your individual income tax rate, could be reduced by as much as a third or a half due to the tax benefit, due to the tax reduction of that expense. And the other attraction, obviously, for an investor is that if you can put 5% down or 10% down for an investment, and you see growth in that investment, you've grown your capital off 5 or 10%. You haven't grown your capital off 20%. And the difference is your returns have actually doubled. That's a huge consideration for an investor who is seeking return more than just the unpalatability of paying a big fee that you never see again at the start of a loan. Most people encounter LMI though when they're entering the market for the first time and they've got limited resources, and that's why it becomes really important to understand these things. Understanding the approval process is also really, really important. It should be known that when you undertake LMI loan, you've got two approvals to get through. One is with the bank and the other is with the insurer. And they don't always agree. In fact, the insurer can pull up deals quite regularly. It adds extra time, it creates more angst and more burden, more administrative burden to answer all the various questions that these people will throw at you. But the other thing is that there are policies that apply when you enter in these high risk categories. Some of the main policies include stricter recognition of income, for example, particularly for self-employed people, but also for people who have overtime income, allowances, bonuses and stuff like that. They're given less credence under LMI arrangements. And there's also this requirement, particularly when you go over 90%, to demonstrate that you have savings from genuine sources. So you literally have taken 5% is generally the rule, 5% out of your salary and put it into a savings account. And if you don't have that, it doesn't matter how good your income is, you won't pass, because that is one of the policies they introduce when you enter into that category. And there's actually some other ones too. Some situations can introduce credit scoring, and that can be a real problem, because if you've got an affected credit score, the only thing that's going to help you is time. Your credit score will repair over time with good loan behaviour and the like. But when you want to get in the market and the prices are running away from you, time is not your friend. So what are some ways around LMI? How can you avoid it? Family guarantee and parent gifts. Now what this literally means, so family guarantee is your parents or someone related to you says, I have a house here, I have some equity in this house, I'm going to allow you to use that house as collateral, as security for your purchase as well. And so let's say you need to borrow 95%. If the bank can find 15% value out of this house that's being offered as security, joint security, then effectively your loan is seen at 80% and you can pass without LMI. But what it introduces is a situation where you are now responsible for your parents' house, or let's say it's your sister or something, you're responsible for them. If you don't make your repayments, both houses could be on the line. And so it can introduce angst into the family relationship. It's a lot of pressure. So not for everyone. Plus a lot of banks don't really like it either. Parent gift. This is probably more common and it has some pretty well set procedures around it. Banks want to see that a gift is not a loan, so they make parents sign something that says, you don't have to give it back and there's no interest applying and all that sort of thing. And the gift can be enough to get you over the line. It can be enough to just reduce, you might still sit in an LMI category, but you take it out of 95% and go into the sub 90% category. That can be beneficial. But be it knowing that the parent gift always introduces the 5% genuine savings rule. So you still need to save. That's one of the key things. You still need to save. And that's probably the other one to bring in here with regards to avoiding LMI, just save more. But that's like pretty mean advice, I must admit. It's not always easy. Cross-securing. If you have property already, you can bring in another property, and just like the family guarantee thing, 2 properties combined means there's enough value to bring that overall loan to value ratio under 80%. It does mean that both houses are potentially on the block if there's any problems with that loan. So not always palatable for all people, but at least it's your home and not someone from your family. Okay, now there's a couple of other ones. We're sort of getting into the odds and ends here. No LMI lenders. So there are lenders who don't charge LMI. So basically all they do is they charge you a higher interest rate with no upfront fee or premium, and that's how they factor in the risk of your higher loan to value loan. But generally that interest rate is much higher, and so most owner-occupied rates are in the low 6s at the moment. We're talking low 8s. Now, but this is really, really a good one. If you're in a particular type of industry, if you're in a particular type of profession, you can actually qualify for no LMI exemptions, which means you can borrow at 95% and LMI is not applied because you're seen as a low-risk borrower. These people include medical professionals, veterinary scientists, sometimes lawyers, and depending on certain types of lenders, military focused banks or emergency service focused banks, they have particular rules that allow you to go to 90%. It's not ubiquitous, so it's really case by case. And then there's one or two banks that'll go to 85% for anyone without applying LMI. So there's a few options there, but by and large, it's all about saving a bit more money, bringing in additional security. Now, I want to wrap up with just a few tips for working with LMI. I mentioned some of the pitfalls, with regards to getting stuck in a position where you don't have, any real ability to refinance. How do you manage that? First and foremost, if you have to enter into the LMI space, try and do it at below 90%, right? Because that is a category where it's, the lowest risk within the higher risk category. LMI costs will be relatively modest compared to where they can get up in the upper echelon of 95 and 98%. And it also protects you, because remember, the policy applies because the bank sees this as a higher risk loan. If it's high risk to them, it's high risk to you. If the property fluctuates in value and you've got a 95% loan, it only needs to go down 5% before you are in zero equity, or 6% you're in negative equity. That means you owe more than the property is worth, and it's basically the definition of hell for most people. They never want to be there, and you're so much closer to it when you're borrowing at that higher percentage. So if you get down to 90%, your buffer is 10%, and generally, you're on a better starting. So that's the first thing. If you're going to have to use LMI, try and get in under 90%. It'll save you costs and it'll save you risk. Once you have that loan, work hard to pay it down. Get to 80% as fast as possible. Now, so there's a couple of ways to do it. You're paying the loan down, so you're paying more than the minimum payments, you're getting through it. And keep an eye on the property value, because as that goes up and your loan repayments are, driving down the debt, you might find that you get to 80% faster than you expect. That makes sense in lots of capital cities where prices do generally go up. Regional areas, country areas, sometimes they don't always do that. But if you're paying down the loan, you are making progress. Be cautious of using LMI when you're unsure about capital growth prospects. So, LMI is, as I mentioned, less problematic in cities when you can kind of rely on property values just going up and up. But in regional areas, it gets a bit sort of more complex. Sometimes it's just flat. Sometimes it goes up and down. I come from Karratha. We've had cycles in property values, and at one point in time they dropped 40%. And for most people in the country, that's like totally unfathomable. Okay guys, that's it from me for today. Thank you for listening. I hope you learned a little bit about what could be a potentially boring topic. LMI, very, very useful, but just like anything, it's like, playing with fire, I suppose. It's, wonderful when it works, but it can lead to bad outcomes. Knowing all about it, getting the right advice from someone who can tell you the ins and outs and how to navigate the system is really, really beneficial before you dive into those higher risk loans. Okay guys, I'll catch you next time. Thanks for listening.